Maximizing your cash flow. Overcoming negative cash flow challenges. Cash flow is the lifeblood of any business or venture. Without sufficient positive cash flow, even the most promising endeavors can grind to a halt. However, maximizing cash flow is not always straightforward. There are numerous potential causes of negative cash flow, from economic uncertainties to poor financial planning. Fortunately, with proactive strategies across key areas, it is possible to transform precarious cash flow into a source of stability and growth. Understanding cash flow dynamics. Before exploring solutions, it is essential to understand what cash flow encapsulates. Cash flow refers to the net movement of cash into or out of a business over a designated period, typically measured monthly or annually. It comprises cash inflows, the money entering the business from sources like sales, drawdowns on financing, sale of assets, etc. Cash outflows, the money leaving the business from expenses, loan payments, investments, etc. Positive cash flow means there is a surplus, with more money coming in than going out. Negative cash flow is the opposite situation, often requiring the tapping of limited cash reserves to fund operating losses. Why maximizing cash flow matters. Positive cash flow fuels growth potential. It enables the flexibility to seize opportunities, invest in innovation, and build a buffer against unexpected shocks. Without it, even profitable firms can experience severe financial stress. As the veteran entrepreneur Richard Branson noted, look after the pennies and the pounds look after themselves. The key is positive cash flow. Common causes of negative cash flow. Macroeconomic factors, recessions, inflation, market crashes, etc. High operating or production costs, excess inventory and operational inefficiencies, late client payments, overexpansion and inability to scale, poor budgeting and financial management. The repercussions can be dire if unaddressed, from supply chain breakdowns to insolvency. Fortunately, a combination of strategic cash flow management, expense reduction, revenue boosting, and risk mitigation measures can turn the tide. Boosting cash inflows. Growing cash inflows sustainably is a multifaceted endeavor. It requires tapping new income streams while maximizing existing ones. Diversify revenue sources. Reliance on a single product, service, or customer segment leaves cash flow vulnerable to external shocks. By developing diverse revenue channels, businesses insulate themselves from fluctuations in particular areas. Possible diversification strategies include offering new product services, expand your catalog to access new customer bases, conduct market research to identify niche demand gaps, entering new geographical regions. If relying solely on domestic markets, expanding internationally spreads risk and opens up opportunities. Consider franchising as a rapid entry model. Developing recurring subscription models. Deliver product services via subscriptions for predictable, recurring revenues. Software and content businesses are increasingly adopting this. Building sales funnels and upsell opportunities. Guide customers through tailored sales funnels, directing them to premium offers once purchased base products/services. Industry example. Facing slowing ad revenue growth, Meta has invested billions into pivoting to virtual reality offerings to diversify income streams. Optimize billing cycles. Delayed client payments are a massive cash flow drain. Analyze your billing processes, identify pain points causing payment delays, and address them through shortening payment terms. Require advanced deposits and immediate payments instead of net 30 terms. Automating invoicing and dunning. Automated invoice generation and prompts limit human error and delays. Offering discounts for early payment. Incentivize customers paying within 7 days through discounts. The immediate inflow often outweighs small discounts offered. Tight payment cycles translate into better cash flow for asset accumulation and investment. As billionaire Warren Buffett said, you only have to do a very few things right in your life so long as you don't do too many things wrong. Focus on getting the billing fundamentals right. Generate passive income. Passive income from assets earning money with minimal day-to-day oversight preserves time for focusing on high-return activities. While launching new products and services has higher risk and input requirements, relatively stable real estate, securities, royalties, etc. passive income sources are accessible. Ways to build these streams include Purchasing dividend stocks, funds. Gain dividend payouts from stock ownership without active management, compounding over time. Investing in rental properties. Beyond appreciation, rent payments deliver largely passive revenue, minus some oversight work. Creation of online courses or tools. Offer digital self-serve content software for recurring passive sales. Securing patents, copyrights, franchises. Royalties from licensing intellectual property rights rewards past work. Savvy passive income portfolio blending limits overall risk while leveraging assets complementing active ventures. Reining in cash outflows. With income maximization in motion, simultaneously limiting cash bleeds amplifies its impact. This involves healthy budgeting, cost optimization, working capital management, and adapting operations where feasible. Practice lean budgeting. Budgeting is essential for aligning expenses with strategic priorities based on projected cash inflows. Key principles include: build budgets from zero. Assess each expense line item critically rather than adjusting previous periods' budgets. Allocate based on ROI. Divert funds from low-yield costs towards initiatives directly impacting cash flow and growth. Set upper limits. Establish monthly limits for expenditures to detect excess outflows. Automate where possible. Reduce reliance on manual payments by setting up direct debits. Review budgets dynamically. Revisit budgets monthly and adjust drastically if required, rather than rigidly sticking to original plans when circumstances change. The goal is to ingrain a culture focused on resource optimization and continuous improvement. Optimize operations and inventory excess. Inventory and bloated operations are cash flow killers. Whilst cutting marketing or innovation investments hampers growth, identifying operational inefficiencies offers high returns. Tactic examples include: adopt just-in-time lean manufacturing. Only hold essential inventory as finished goods or materials, avoiding waste. Streamline processes. Eliminate redundant steps through detailed process mapping and analysis. Renegotiate supplier and vendor rates. Leverage order volumes for discounted raw materials or services. Outsource non-critical functions. Redirect resources from ancillary functions through specialized outsourcing partners. Scaling back expenses through structural operational improvements fortifies long-term cash flow stability. Building risk resilience. With the precarious, fast-moving modern markets, no business is immune to unexpected shock events destabilizing cash reserves. However, through preemptive measures, the impact of such occurrences can be mitigated. Hold prudent cash reserves. Having ample cash buffers offers a vital fallback for temporary cash crunches from delayed payments, lawsuits, supply disruptions, etc. Benchmarks for minimum cash holdings vary by industry and business model, but holding over 6 months of operating expenses is a common recommendation. Diversify asset classes. Rather than concentrating wealth solely in a single asset category like securities or real estate, spreading across varied, unrelated asset classes lowers correlated risk. Blending in historically stable asset classes like bonds, commodities, farmland, etc. decorrelates portfolios from stock market volatility. Utilize insurance and hedging instruments. Specialized financial products like options contracts and currency swaps help hedge businesses from common risks like interest rate shifts or foreign exchange movements which threaten cash flow streams. Similarly, customized business insurance shields against disruptions. The aim is not elimination of risk, but calibrated mitigation facilitating stability through storms. In summary, transforming negative cash flow requires a combination of boosting cash inflows from new income streams and tighter OPEX and working capital management. This necessitates continuous adaptation, actively expanding in-demand offerings while scaling back legacy ones. With strong financial controls and contingency planning, businesses gain resilience to ever-changing conditions. Cash flow optimization is thus an active, omnipresent process. But the rewards for getting it right are game-changing growth potential. Take control of your financial destiny through the strategies above. Call 888-653-0124 today or click the link in the description to learn more and share your success story.